Okay, so now we've reached the foundation, and the foundation of any financial plan whatsoever is always the life insurance. This is very, very critical because there's really only two ways you could do this. You could do it with whole life, permanent cash value insurance, or you could do it with term insurance. So, starting out with whole life cash value insurance, how it works is you pay for two things, but you really only ever get one of the two things. Let me explain. Let's say you get a whole life insurance policy for $1,000,000, right? If you pass away, you get $1,000,000. That generally would cost around $500 a month to have a policy that big. And so, what does the $500 a month pay for? Well, part of it pays for the cost of insurance, the $1,000,000, but the other part of the premium goes to pay the cash value or the savings account to the policy. So, how does this work? Well, it works a lot like any other savings account, right? You put the money in there, it grows. There's a floor on the investment so you can never lose money, but there's also a cap so you can't gain as much. Bottom line, just remember this, on average, it earns you anywhere from 3 to 5%. So here's three caveats about whole life permanent cash value insurance a whole life salesperson will never tell you. Thing number one is that up to the first 5 years of your deposits, the agent actually keeps for commission. So I want you to stop and think about it. If you were to go open a bank account with, let's say, Chase, and you open it up and you start depositing your money for the first year, the second year, and the third year, and then you go back to withdraw some of that money, and they say, hey, Mr. Client, your balance is 0. Had you known that in the beginning, would you ever open that bank account? So thing number two about these policies that they conveniently forget to tell you at the time of purchase is that the only way to access this money tax-free, like they said, is through a loan. You have to remember you put the money in there. So when you take the money out, you have to pay interest on your own money. It's like if you were to, that same Chase bank account we're talking about, like if you were to open that account and then you were to go to take money out of the account, they said, sure, Mr. Client, it's been after that 5-year threshold. You have access to X amount of money. Go ahead, take what you like. So you pull out $10,000. And they say, okay, you can have your $10,000, but just know you're going to be paying interest on that money for as long as you have it. Would you ever open that account? Generally speaking, most people would not. But again, at the time of sale, they never mention this stuff, so most people do. And the third thing, probably the worst of it all, is when you die, you only get one of the two. Generally speaking, you only get one of the two. You either get the $1,000,000 of death benefit or whatever money you've accumulated in your savings account. And so let me explain how this works. So let's say you're 80 years old, right? You're 80 years old, and let's just say your account has grown to $800,000, right? So the insurance company pays you the death benefit, right? So they pay you $1,000,000. Let's write it down here. They pay you $1,000,000, and your cash value is $800,000. But they keep it. They keep the $800,000. So how much did they really pay you? They really paid you $200,000. So the entire time you've been paying into this account $500 a month just for them to pay you $200,000 at the end of the road. So that, in a nutshell, is how whole life permanent cash value life insurance actually works. They sell it with this air of elitism, like, oh, you're so smart for getting this product because you're going to have a tax-free retirement, which isn't necessarily true. The only reason it's tax-free is because of the loan aspect. You loan your money to yourself. But every single loan that you get in America is tax-free because it's not your money, it's debt. And so really, permanent life insurance is for those who feel the need to put all their eggs in one basket. And that's really what it boils down to. But this is all really just the math, and I know it's kind of confusing to look at, but go ahead, just do your research. There's tons of literature on this for Finance for Dummies. Dave Ramsey talks about this all of the time. Go ahead, use ChatGPT. Don't just take my word for it. But this is exactly how it works.